Okay, so this video I'm going to talk about balance sheet projections. When projecting the balance sheet, things are going to be a little bit different compared to the income statement. And the reason for that is basically because some of the items in the balance sheet we really don't think are going to change with sales. And that's going to trigger a little bit more of a line-by-line approach potentially. So if I am doing a balance sheet, I can kind of start with the percentage of sales method. And basically what I would do is kind of what I did in the prior video for like say cost of goods sold. And basically I will take a line item, say cash. I will express it as a percentage of sales. So the most recent cash figure divided by the most recent sales figure. And then I multiply that times my uh, projected sales figure to get my projected cash figure. And that's not a bad approach to start with. So basically what I might wind up doing then is sort of increasing most, if not all, assets with sales to account for the fact that we're gonna need extra capacity. So if I'm gonna sell more, makes sense. I might need more cash. Might wind up with more inventories on hand to support the sales. I may or may not need more net fixed assets and kind of work my way down the list of assets and things like that. But generally, a lot of those, I make a pretty fair argument that maybe they would increase. Um, so from that standpoint, kind of work your way down the list for the assets, and often they will need to increase. Now, net fixed assets is kind of an interesting subset for that, and this can be true for some of the assets as well, other assets as well. But net fixed assets can be an interesting case. So if I had excess capacity in my manufacturing facilities, I might well be able to increase sales and do nothing to change net fixed assets. On the other hand, in which case, basically, you would just keep that net fixed asset figure the same in your projection, and you would not increase it. And if anything, you actually might even account for some depreciation in there as well. But net fixed assets can be lumpy, and so what that means is if I am expecting a 10% increase in sales and I need to have more capacity, it's not like I can just take a sledgehammer to the back wall of my factory, bash out the wall, pour a little bit more slab, and presto, I've got 10% more capacity. The reality is it's probably a lot more complicated than that. I might have to build a whole new manufacturing facility to get more capacity. And if I'm building one, I may not wind up building one that can only do 10%. I might wind up building one that could actually increase my sales by 50%. And so sales are going up by 10%, but now all of a sudden I'm buying fixed assets that's more equivalent with a 50% increase in sales. So that's what I mean by kind of lumpy assets. It's not, I may not be able to scale down my net fixed asset purchases to just support a tiny little increase in sales. I might have to buy a whole bunch of net fixed assets to support even a small increase in sales because I might be just completely maxed out. Now what that would mean then is I might wind up spending a bunch of money on net fixed assets right now, way more than you would think would be necessary given the increase in sales I'm expecting. But then I got all kinds of extra capacity. So in the years after that, I might well be able to increase sales without doing anything to my net fixed assets for a while because I've got all this extra capacity. So net fixed assets can kind of be lumpy, where all of a sudden I have to buy a bunch of fixed assets, then I'm good for a while, and I got to buy a bunch of fixed assets, then I'm good for a while. Whereas something like cash or inventories, I can probably increase that more smoothly as sales increase. So net fixed assets get kind of interesting. Now, if you are working within a firm and you have access to information about just what kind of extra capacity you have, you can try to model that very specifically with, all right, here's how much I can support with my current net fixed assets. Here's when I'm going to need to buy more net fixed assets. Here's what that's going to cost. And we can try to account for that in a multiple year forecast, and that'd be great. However, if you're on the outside looking in and you're analyzing, say, a publicly traded company or something like that, and you don't have access to that information, then we know that although net fixed assets are kind of lumpy and they come in jumps, basically, not just nice little smooth increments like inventory or cash might, then one of the things that we could do is sort of assume as an approximation that the net fixed assets are going to vary with sales and just kind of let that assumption be, but recognize that there are limitations to that. And really that means our forecast is going to have a little bit of error on it because in some years it's going to look like I'm better off than I am and I actually need more money than my forecast says. But other years I'm going to have more money available than it looks like I might actually think for my forecast. So you can kind of approximate it by assuming things very nice and neatly with sales, but kind of recognize it's likely to be off to some extent. But again, if you're on the outside looking in, you may not have access to enough data to really figure out what's going to happen. And so that's where you might have to make some assumptions, basically. Now, when I get to liabilities, you're gonna want to increase what are called spontaneous liabilities with sales typically. So things like accounts payable, wages payable, taxes payable, things like that are typically you'd expect to increase with sales. Let's walk that through. So if I increase sales, so if sales go up, I'm probably going to buy more product. If I buy more product, I'm buying more inventory. If I'm buying more inventory, then probably I'm going to wind up with more accounts payable because I'm going to pay my suppliers more. So there's kind of a direct link there between selling more, buying more inventory, probably more accounts payable. So it kind of makes sense that accounts payable would vary pretty directly with sales. Wages payable, if I'm selling more, I'm probably hiring more workers or paying more workers more hours. So it makes sense that probably what I'm going to pay my workers, my wages payable, things like that would probably go up pretty consistently with my sales as well. Taxes payable. Well, if we're selling more, we're hopefully making more money. That's certainly the goal, kind of in this context. So we're hopefully making more money, which would mean I'm probably going to need to pay the government more, which means I'm probably going to wind up with more taxes payable. So it kind of makes sense. Taxes payable would need to go up with sales too. So there are some liabilities that you would normally expect they're going to be sort of spontaneous in the sense that I'm going to sell more and pretty much automatically I'm going to wind up with more of these liabilities just by running my business. I'm going to wind up with more of these liabilities. And there could be some other current liabilities as well that this occurs with. Now, I want to separate those spontaneous liabilities from some other kind of current liabilities that are non-spontaneous. So things like bank loans. Just because I sold more product or services does not mean that I wind up with more bank loans. To get more bank loans, I have to go convince some loan officer somewhere to sign on the dotted line to let me have a loan, basically. And they may not. So that's not going to be spontaneous. Just because I sold more does not mean the bank is going to lend me more money. Also, short-term portions of long-term debt. That doesn't change with sales. That's only changing with what's happening with my long-term debt and how it's coming due. So if my long-term debt is coming due in the next couple of years, it's going to roll into short-term portions of long-term debt. It has nothing to do with what's going on with sales. It has everything to do with when the debt is coming due. Commercial paper is basically short-term borrowings, but through the financial markets. And so basically it's issued in the financial markets. And again, that's not going to vary just because I sold more product or services. That's going to vary if I issue more commercial paper. So that's not going to vary with sales. That's going to be a separate item. So there would be certain types of current liabilities that are considered to be spontaneous that you can make a good argument for. If I increase the sale of my product or services, I'm pretty much going to wind up with more of these. And that's the accounts payable, wages payable, taxes payable, and occasionally a few other things too. But the other areas like bank loans, short-term portions of long-term debt, commercial paper, things like that that might show up in current liabilities. If it involves somebody else outside the business having to make a decision for me to wind up with it, pretty much is not going to vary directly with sales. Accounts payable is sort of a little bit of an exception there. I mean, technically, some other business has to decide to extend credit to you. But if it's your normal supplier, they probably made that decision long ago, as long as you continue to pay. And so it's pretty spontaneous unless they start changing things all of a sudden. Now, we talked about assets. Probably as a starting point, could probably assume most of the assets are going to vary with sales. But there's some questions about some of the things like net fixed assets that they may or may not. For the current asset or current liabilities, the spontaneous ones would, other kinds of current liabilities, not so much. That brings us down to long-term liabilities. So if I look at long-term liabilities, basically they're going to stay constant, except for resolving this AFN, which stands for additional funds needed issue that I'll talk about in a minute. So long-term liabilities, think bonds payable, notes payable. Just because I sold more product or services does not mean that all of a sudden I now have borrowed more money in terms of bonds payable or notes payable. I had to convince people to lend me money through bonds payable or notes payable for me to get that money. So long-term liabilities just don't change because I sold more product, right? So basically, that's going to be something that's not going to change. Also, when I look at my equity accounts, well, pretty much my equity accounts, with one exception, just don't automatically change with sales. So if you think about paid-in capital excess of par, those kinds of things, they don't change with sales, right? That was when I issued shares of stock. That's not when I sell my product. Now, the one exception to this is retained earnings. So if you think about it, retained earnings is coming from the income statement, and it's the money from the income statement that I didn't pay out in dividends. So if I sell more, I hopefully get more net income. If I get more net income, I may well retain more, right? Because some of it's going to retained earnings, some of it's going to dividends. And the stuff that I retained actually is affecting the balance sheet. So for retained earnings, that is going to be changing as sales change, but due to basically the amount of net income that I retain. So you wouldn't do a percentage of sales on retained earnings. Rather, what you do, you go back to the income statement, we get that bottom line net income figure, and you have to split that net income figure into what's going to go to retained earnings, what's going to be paid out in dividends. And that is going to dictate what the change in retained earnings is. So again, project your income statement, get your income, and then split it into here's what we're going to pay in dividends, here's what we're going to retain. That amount you're going to retain, that is going to add to the prior year's retained earnings to get the projected retained earnings. So if you think about what we're doing on the balance sheet, really at some level, we're already having to tweak things a little bit with the net fixed assets we don't know. We're having to account for the fact that certain liabilities change, certain ones don't change, things like that. So you can make an argument for using what's called a judgmental approach, where basically you use judgment and create customized forecasts line by line. And really what that kind of is going to lead to is you might wind up varying some accounts on the balance sheet in proportion to sales. You might try to account for some things being sort of, some things like certain assets being lumpy assets. You might also note that based on my expectations, certain accounts are going to stay the same. And so you can customize it. Maybe you look at your cash position, you're like, you know what, I got plenty of cash. I do not need any more cash. So if I'm projecting this out and I'm doing a judgmental, customized forecast kind of approach, I look at cash and say, I've already got plenty of cash. Even if I sell a whole bunch more, I just don't need any more cash. So I could custom forecast that is, I'm going to keep the cash the same. I'm just going to keep it the same. And then you could look at the next line item in your balance sheet and work up a customized forecast for that based upon the unique circumstances of the firm. And basically vary certain things with sales, keep other things maybe the same, account that for the fact that, all right, I need to buy fixed assets, but it's going to come in a huge lump. It's not just going to go up in the same proportion of sales. So you could actually do like a customized line by line forecast. Obviously, that's a lot more work. But it might also be more accurate if you have a situation where there are a lot of unique circumstances going on. And so that's something you'd want to evaluate potentially. Now, if you kind of look back at what I've talked about so far, I've talked about projecting assets, projecting certain liabilities are changing, other liabilities are staying the same, talking about which equity line items are going to stay the same compared to which ones are going to change. Retained earnings is going to be changing, but due to what's going on in the income statement. So really, I've kind of worked my way through projecting a good portion of the balance sheet. Now, here's kind of the big picture of what's going to be going on here. So if I'm expecting an increase in sales, that may well trigger like I need more assets to produce the product or services that I am selling. So the asset side of my balance sheet is going up. Now, I'm also projecting that some of the liabilities are going to go up. I'm also projecting that equity is going up, at least to an extent, through the retained earnings. So kind of when I'm doing my projected balance sheet, what I'm looking at is I'm projecting the growth in assets, I'm projecting the growth in liabilities, projecting the growth in equity. And now we should compare them. And so let's suppose that I project out that at the end of the year, I'm going to wind up with $100 million of assets, and I'm going to have $30 million of liabilities and $50 million of equity. If you're doing the math, you're like, oh, wait a minute. $100 million of assets, $30 million of liabilities, $50 million of equity. That doesn't add up because the liabilities and equity only adds up to 80 million. Well, that would be where we have what's called the external funds needed, or sometimes it's called the additional funds needed. So in that example, basically I would take the assets, 100 million, minus the liabilities of 30, minus the equity of 50. I'd arrive at, basically I need $20 million more funding. So I need more funds. And kind of what's driving this is if sales are going up, then I'm expecting that assets are going to need to go up in order to support the sales. Some of the liabilities are going to go up, some of the equity is going to go up just sort of automatically. And I'm trying to figure out how big of a funding gap do I have? How much money am I going to need to raise to pay for all of these assets? Some of the money is going to happen just as I sell more. I'm going to make more profit. I'm going to get wind up more liabilities. So some money is going to be flowing into my business just by virtue of running the business. What we're trying to calculate here is how much more do I need on top of that to make this occur? And if I'm trying to figure out how much I need in order to make this occur, then that's where I get to that additional funds needed or external funds needed. So I look at my projected asset level, my projected liability level, my projected equity level. I compare those and I calculate an additional or external funds needed. It's called external because I've already accounted for everything that my business is doing to produce funds. So back to my example. So if assets are projected to be 100 million, liabilities are projected to be 30, equity is projected to be 50, I'm $20 million short. And so basically what that means is I need to go raise $20 million. So if AFN or external funds needed gives you a positive number, it means I need to go get more money. So assets minus liabilities minus equity. If you wind up with a positive figure here on my projections, I need to go get more money in order to make this growth happen. If I don't get more money, I'm not going to grow as much as I expected. Okay. So you think about basically the places I could go to get more money. Well, I haven't borrowed long term yet, right? That didn't change. And I haven't issued any stock yet. So if I need another $20 million, maybe I go borrow it by issuing bonds, or maybe I go issue stock, and I get to $20 million to get the money that I would need to buy the assets that are part of this growth plan. Hopefully that kind of makes some sense. Now it's worth noting that when I start projecting out the balance sheet like this, the AFN figure could wind up positive or negative. So the positive means I need to go raise more funds. Negative would mean I actually am projecting I might have excess funds available. So here's what that would look like. Let's say I project out my balance sheet and I'm projecting that in order to support the level of growth I'm going to have, my assets will be $100 million at the end of the year. But I am projecting that my liabilities will be $60 million. And I am projecting that my equity will be at $50 million. Well, 100 million minus 60 minus 50, it's a minus 10. So I'm projecting that my liabilities and equity are going to be $10 million higher than my assets, which basically means I don't need to go get more funding. I got more than enough funding available to support this growth. Or another way of looking at that is enough money is going to be coming in to my business to pay for all this growth. I don't have to go get more money. So a negative external funds needed or negative AFN means that I don't need to go raise more money. I have extra funding available that I could then go use to buy more assets or something like that. Now, an important little side note for the more accounting inclined. All right. So if you're more inclined or more of the accounting persuasion, you might be like, but the balance sheet has to balance. Absolutely. Okay, the balance sheet does have to balance. So at the point in time when I make a balance sheet on any particular day, when it's an actual balance sheet, it better balance. Side note, if it doesn't balance, this is when you fire your accountant. Okay, because I mean that's like day one in accounting. The balance sheet has to balance. And if it's not balancing, we got big problems, right? The balance sheet has to balance. But what we're looking at here is I'm projecting how the assets are going to go. I'm projecting how the liabilities are going to grow. I'm projecting how the equity is going to grow so that I find out how much do I need in terms of additional funding for all of this to play out. Because by the time I get there, the balance sheet is going to have to balance. So if I don't get the funding, what that means is I'm not going to be able to buy the assets that I needed to support the growth. I'm just not going to be able to grow as much. So that's one possible outcome. Or if I do get the funding, I raise more capital, then I can buy those assets and my liabilities and owner's equity are all going to add up so that my balance sheet balances. Okay. So at any point in time, your balance sheet better balance. But what we're looking at here is I am projecting things out and assessing basically, all right, based on the trends that I'm projecting here, do I need to go get more money to make all this happen? Or am I going to have more than enough money to make all this happen? That's the idea. Okay. And that's kind of the point behind additional funds needed. So if additional funds needed or external funds needed is positive, it means we got to go raise funds. If it's negative, it means I'm going to have more than enough funds to make the growth happen that I am expecting. All right, hopefully this video has been helpful. Thank you so much for watching and have a great day.